Hi everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining me here today is Justin Nielsen, who is a market research director over at Investors Business Daily, and he's also the longtime assistant to William O'Neill himself. Justin, thank you so much for taking the time to speak with me here today, and welcome.
Hey, thank you, Richard. It's great to be here with you. I just finally good to meet you in person, I guess. Well, kind of in person. Heard
Virtually,
so
yeah.
much about you.
Yep. Ross says great things about you and working with you over there at IBD with Mike Webster. So yeah, it's great to meet you, and we're going to cover a lot today, including your background, trading style, some William O'Neill stories, I'm sure today as well. So dive right in. Could you kind of give us a sense of how you got started at IBD and just how you first got interested in the markets in general?
It was really a fluke. I was actually working with a recruiter. I was straight out of college and I was looking for a job. I planned on becoming a teacher. So I was looking for a job just out in the business world for a year and then wanted to kind of get my feet wet so that I had some other experience other than just being in school the whole time. And the recruiter kind of said, "Hey, I got this job, but man, it starts at 6 in the morning." And I was not much of a morning person. But when she told me that it was Investors Business Daily and it was regarding the stock market, I had no real background in the stock market. I was an anthropology major in college. I had only taken a semester of economics that was mandatory in high school. So I just was very curious and I wanted to learn about it. And so I said, you know what, I'll take the job. And I'm very glad I did because that 1 year turned into 25 at this point, because that was back in September of 1997.
Yeah, perfect. And talk to me about eventually becoming William O'Neill's assistant. I would imagine that's quite a feat, and also definitely a little scary, of course, for a new college grad as well.
Well, that happened probably about a couple years into my tenure. And what happened was I was getting more involved in some of the education aspects of Investors Business Daily, of the customer service department. So I would go out and speak to like little groups, sometimes in people's homes, just going through the paper because that was our only product at the time. And I was also, our VP of operations was kind of interested in, yeah, looking at some different data of what was going on in the customer service department, some of our stop save programs, some of our sales programs. And I was learning Excel and he just kept on asking me questions and I kept on getting more and more into Excel. And it was some of these projects that I was working on where I was giving him data and answering questions for him that got me the attention of Scott O'Neill, Bill's son.
Hmm.
He was publisher of Investors Business Daily at the time, and then eventually that got me on Bill's radar. And he had a longtime assistant at that time, or at least for a few years, and she was real bright gal, and he was planning on moving her into a marketing manager position. So he was looking for someone. And so he brought me out to lunch and I thought it was going to be about this project. And it turned out that he was going to offer me a job. And so again, I was thinking, well, gosh, I eventually am going to get back into this teaching thing. But then this opportunity came around and I'm like, I can't really pass up working directly with Bill O'Neill himself. So again, I took the job and it's been just a great tenure. 15 years probably that I was working with him. And sometimes it was a lot of day-to-day operation stuff. Sometimes I was doing special projects. He would loan me out to different departments. So I sat in ad sales for a while. I worked with the accounting department for a while. Editorial, I sat in there for a while. So I kind of got all over the place, which was, again, no day was the same. I never knew what was going to face me, and that was always very exciting about my job.
Yeah, that's fantastic, and we're gonna dive deep into your Excel knowledge and studies later on because that's definitely something that you're known for. At least Mike Webster says you've got that famous Excel sheet that's huge. So
Right.
definitely want to cover that.
Millions and
But
millions of cells.
millions and millions of cells, absolutely. But I do want to get into kind of you're learning about trading, that side of things. So what were some resources, books, webinars, working with Bill himself? What kind of helped speed up your learning curve?
Well, of course, the first thing that I had was, when I started working at the paper, they plopped the How to Make Money in Stocks on my lap. And this was the second edition, so it was the red book. And I just read that whole thing over the weekend before I started the job. And I was lucky enough that the guy next to me when I was working customer service, he was one of the education gurus. So I was constantly bombarding him with questions. Like if I got a question on my call, I would be like, hey, asking him about this. And he was a wealth of knowledge. That guy's name was Mike Hewson. And so he really helped me out, speed up my learning curve. Ken Shreve, he still is on IBD Live. He still works with us. He was also in the education department. He was answering a lot of emails on AOL.com back then. So he was another wealth of information. So just picking the brains of people. And it was kind of nice because not everyone was interested in it in the customer service department. You had some people that, hey, they just wanted the job. They just wanted to kind of answer the calls, go home, and then not think about it. But then you had this whole host of people that were really interested in the market. And so you were kind of surrounded by people that were learning together, or some people that actually were pretty good at it already. Mike, I feel like he was probably making more money in the market than he was with his customer service job. It's just that he liked where he was working, right? It was, hey, I can take these calls and watch the market, have access to all this information. So there was a lot that helped me out at the beginning. And I'm very grateful to be lucky enough to be in that position where I was surrounded by all that information available to me. And not only that, but I was coming at it with a clean slate, right? I didn't have all of these theories of, oh, this is the way the market is supposed to work. It was, hey, here's Bill's book. And I kind of learned that way as the only way at the beginning. It wasn't until later that I started learning, oh, there's a whole bunch of different ways that people do this whole game.
Yeah, absolutely. And outside of Bill's book, what are some other books that are very complementary in that and kind of teach the same, focus on base breakouts, risk management, approaching the market the similar way? What are some other titles that you think would be good for especially beginners to learn about the market?
Well, I mean, certainly there's the classics, and this came straight from Bill himself. He kind of had his reading list, and a lot of us asked, okay, after How to Make Money in Stocks, what else is there that we can read? And one of his favorites, of course, was Nicholas Darvis's book, How I Made $2 Million in the Stock Market. Gerald Loeb. It's a little bit of a denser read. I remember the first time I read that, I was like, whoa, this is just a little bit tougher to get through. But the Battle for Investment Survival. And Bill had some great stories of meeting Gerald Loeb. He really respected Loeb, and when he met him, it was a big thrill for him. And then of course Jesse Livermore, whether it's How to Trade Stocks or the kind of biography type thing of Reminiscences of a Stock Operator, both of which just really gave you kind of a sense of that tape reading and getting into that. So those were some early kind of things. Market Wizards, at that point David Ryan was still working at the firm for a while, and I was lucky enough to, one of the first events that I ever went to just a couple months after I started working there was a workshop where Bill O'Neill was speaking with David Ryan. And it's just, okay, well, now I'm learning from two amazing, people in this field. And, I just felt very lucky because this was something I got to go to for free, just for working at the company.
Yeah, that's awesome. And I wanted to dive a little bit deeper into working with Bill and being his assistant. What were some kind of key lessons that he taught you and that you learned through experience, working with him every day, doing those special projects, and just seeing how he approached the markets, approached his routines, and also his trading?
Well, I guess more than just the stock market part, there was just kind of, he was just a very unique individual. So working for him was very thrilling in that way. Certainly a number of things that I kind of took away from the experience was it's not just about the trading and everything like that. There's also a whole mindset thing. He always really approached it with a level of humility and the idea that there's always more to learn. He was never one to just kind of sit on his laurels and say, okay, well, gosh, I've made a lot of money and this is it. I'm kind of at the top of my field, never mind getting better. He was always looking at ways in which to get better. And I think that was just very inspiring. He also had just a great deal of optimism, just about the opportunities that were available, especially living where we do in the US with all of the innovative companies that are coming up with new ideas all the time. The idea that, okay, you get in these bad market turns. He always approached it with, hey, look, this is where the opportunities come from. And, keep in mind, when I started, it was in the late 90s. So, of course, everything was internet this, network that, Cisco systems, what have you, Yahoo, all of these things. And then we had the dot-com bubble. And, I watched Bill through that portion. In 1999, when I started, it was really at the tail end of that. And so, even at the worst, moments of that 2000, he never looked at it as, okay, I've got to get out of this game. It's over. It was always like, hey, this is what happens. Even though that was one of the worst corrections of all time, he still took it in stride because he had gotten out, so well, and he knew how to manage his risk. So he was just looking for that next opportunity because he knew that, hey, when we come out of this, it's going to be great.
Yeah, absolutely. And were there any kind of key stories or moments that you kind of experienced with Bill that really stood out to you and that taught you kind of a really important lesson either about trading or just kind of life in general?
Well, I mean, there were so many. It's hard to kind of, I mean, 15 years, there was just so much. I felt so lucky in that regard. But I will say that one of the favorite things I got to do was, work on his presentations, or when we went to revise the How to Make Money in Stocks, this was the book that got me started, the second edition, and I helped revise the third edition and the fourth edition. And for both of those, especially the fourth edition, I was very heavily involved in the chart creation. So we kind of were getting things a little bit off of the mainframe, and I was able to create the charts and mark them up. I always joke that I feel like it should have been How to Make Money in Stocks, William O'Neill, author, and Justin Nielsen, illustrator, because I did all the charts, marked them up. But in doing so, it was really sitting down with him and getting all of these stories about all the minute details that he was seeing. And some of these were stocks that he traded. And, sometimes at a certain point, I started almost internalizing his stories. Oh, yeah, Chrysler, when that came out at 57 and 5/8 in, October of 1962 after the Cuban Missile Crisis, I'm like, I wasn't even born then, but I knew the story like the back of my hand. And, the Love brothers were, buying it down here, and Gerald Loeb was buying it at the same time that Bill was. So, just hearing a lot of these stories over and over really helped internalize some of these concepts. And the truth is, some of these concepts, they kind of take drumming in a little bit. There's some of them that, you don't just read the book once, right? I remember, I can't tell you how many times I've read the book, because in revising it, of course, Bill was not one to just, let me make a few notes and then that's it. He was constantly editing, re-editing, changing, making tweaks, taking out single words right here, or just replacing words. So he was always trying to improve it in one way or another, until at a certain point we just almost had to say, okay, it's done. We have a deadline that we have to get to, so you can't make any more changes, because every time he looked at it, he would just think of just one little thing to make it a little bit clearer, a little bit more concise, a little bit better. And that's really who he was. It was always about being a little bit better each time around.
Yeah, very cool. And I'm actually due for a reread. I'll probably pick it up next week. You kind of inspired me to do that. So, but for people who maybe have never read it and they're just hearing about the book for the first time in this interview right now, what advice would you give people in terms of approaching reading it? Because there's all those charts at the beginning that are an amazing resource, but maybe if you haven't learned about the basics of CAN-SLIM, how to read charts, should they look at those charts first, or should they go to the material and then come back at the charts, take notes, and kind of analyze it? What would you kind of recommend?
Richard, there was such a controversy putting those charts at the beginning. Bill was adamant about it. He's like, and keep in mind, it was really revolutionary that we had some of those charts to begin with. He had a major project going on where it was, let's get some of this data. So he had two teams going through Wall Street Journal's, New York Times, putting all this price and volume data in from these papers going back to the 1880s. And these were some charts that people had never seen before. The
Right.
only time they had been kind of created was on chalkboards as kids, wrote the tape down and kind of created these charts live. So these were charts that no one had ever seen before. And he really felt strongly that this is something that people need to see, because he was even amazed at how timeless some of the principles were. He certainly had his own studies starting in the late 50s, early 60s, but the fact that these concepts held true, I think was even gratifying and also surprising how well these concepts held, going back to the 1880s and really the beginnings of some of the capitalism and construction of the U.S. So it really is something where these charts are important. I think they can be motivational in terms of showing you what's possible, but you have to be careful not to get stuck on the minutia, because that can be intimidating for a lot of people. And that's where the controversy came in. So many people were like, look, you're going to scare people off if this is your chapter one, where you just start with all these charts. And again, Bill was adamant. He said, no, this is just too important. And it wasn't until, I would say, maybe 6 years after the book came out that he said, maybe it could have gotten a little bit further back. Maybe that was a little much to start people off with. But I think if you just kind of do a brief overview and then think of that first chapter as going to be your reference book, because you're going to go back to a lot of those concepts. Some of those concepts aren't going to mean anything to you the first 3 times you read the book. It's not until you've got some experience, and this is what I found myself. When I started trading and I read the book, it was almost like a whole new book to me, because, oh, that's what he meant with this. And I kind of understood a little bit more. So it's definitely one of those books you have to read a number of times. And The Successful Investor, when that came out, I helped him with that manuscript as well, and those charts. Mike Webster, of course, was heavily involved with these projects as well. But it was one of those things where he was trying to make it a little bit easier. So I think that's a great book for people to start with, and then get more of the details in how to make money in stocks. I didn't have the option of reading Successful Investor first, because it didn't exist when I started.
Yeah, fantastic. And highly recommend reading those books to everybody watching. They're really great and amazing resources. And like you said, once you go through your first extensive correction and that first uptrend,
Right.
and revisit that book, it's a completely different read. And there's so many details in there that I highly recommend reading. The link will be down below in the description. And Justin, going back to the special projects you've kind of referenced a bit doing for Bill, I don't know how much you can say, how much is classified, but I'd love to hear kind of your favorite research projects, if you can share that, and maybe some key takeaways about some kind of the output, because obviously we've got the fall through day concept within CanSlim. There's a lot of data and dynamics surrounding that. So I'd love to hear, some stories about doing those projects and any that really stuck out to you and changed how you approach the market.
Well, certainly one of the biggest projects was the whole market school, project that Charles Harris, Mike Webster, and I did together. And of course, Bill, he had these concepts, the follow through day concept and distribution concepts, already pretty set in stone. But what we were trying to do is trying to look at by looking at everything and saying, okay, are there these other elements of price and moving averages and all of these things? Because there were so many times where we'd look at a follow-through day, or we'd look at a number of distribution days, and he would discount things. He would say,
Mm-hmm.
oh, well, there's a flaw here, that this isn't quite right. Oh, the positioning isn't quite right. And especially stall days, just nailing Bill down on stall days was so tough. So what makes this a stall day over here, but this one that looks almost exactly the same isn't a stalling day? And
Right.
he would explain, well, it's the position. Look at where this is. This is going into new high ground. This one is coming off of lows. So all of these little nuances, it just really helped kind of solidify a lot of these ideas. And it was just really great working with Mike and Charles on a regular basis on that too. But it was also interesting because sometimes we could challenge Bill a little bit, and because I built this kind of database in Excel. And so when he would say, no, these are the characteristics, then I could go into Excel and do some filtering, do some formulas and say, okay, here are the characteristics that you just told us, Bill. Here are a bunch of days, here are ones that worked, here are ones that didn't. What's the difference? And it just really kind of helped solidify some of these things. I remember there was a book by Malcolm Gladwell, where he was talking about how some of these experts, sometimes they don't, the professional tennis player sometimes can't even break down their own stroke. They just, so much of it becomes muscle memory. And I think Bill was kind of at that level. There were some of these things that he had difficulty even, putting down the details. It almost came to a feel for him. But that project really, I think, helped kind of nail down some of the stuff he did by instinct and feel to what it was that he was actually seeing, because we could say, what's the difference between these two things that have the characteristics that you told us to look for?
Yeah. And what advice would you have for traders who want to go out and do their own studies? I'm sure you've done so many that you've kind of developed a procedure where you collect the data, clean the data, all of that. What's your kind of general process for performing a study, and how do you draw those major conclusions after going through that?
Well, one of the things that I remember from Bill's book that really stuck out to me was he has this story, and I don't remember where it came from, but a story about a professor and, talking to his class about, I think it was, writing a paper on fish. And, all these, students go out and they go to the library and, do all this research and stuff like that. And he's like, no, just sit down and study fish, and make observations. So I feel like a large part of what Bill accomplished was through the process of observation, just looking at the market itself and saying, what does the market actually do? So there's that element. But I think it's always interesting when you can kind of take those elements and say, hey, what looked similar in the past? How often has this happened? Can we come up with other instances? And that was something that I used to do all the time with Mike Webster, where he would say, how many times have we had something that looked like this, that had these qualities? And again, I could just run real quickly, and then we would go through them. So a couple of things to be careful of with studies is be careful. You do have to have a certain amount of care that you're taking with these studies. One of the early mistakes I made, and this is embarrassing, and I don't know whether I should share this or not, but an early mistake I made was I was just a day off in one of my calculations. So basically, I was giving credit to the wrong day. Right. So in effect, I was giving credit to something that hadn't happened. I was basically saying, if you have a follow-through day, it's really good to buy on the follow-through day right before it happens. Right. Well, you don't know what's going to happen yet. So that just doesn't make sense. And so when I first ran my numbers, like the numbers were so outrageously great, it was like, oh, why do we ever trade stocks? This market model has all of the answers. And it was like, oh, well, yeah, if you have that crystal ball that tells you what the market's going to do that day, it works out really well. So you just have to be careful and make sure that you kind of always approach things with a little bit of skepticism. Hey, did I do this right? How do I know my sources of information are right? How do I know that my formula is right? And you have to do a lot of checks. I would always, do my formula, do my filtering and whatever, and then look at instances, so I can see, hey, did this do what I actually thought it should do? And this is also really important where you have other people looking at your stuff, because you never know what kind of blinders you can put on. Because sometimes I was working on this stuff late at night, and I'd show it to Mike and Charles and be like, oh, here's what I got. And they would immediately point out a flaw. And without kind of that other pair of eyes, who knows, what kind of things I would miss. So it's really having those checks. It's important that you are careful to not just go with, oh, if I go with these rules, this is what gets me the best performance. You have to look at the instances, the individual, things. And a lot of times I would start with the outliers, the extremes, because sometimes you would find, oh, all of the performance came from this one instance, and how lucky do you think you're going to have that one instance again? So are you going to change all your rules for how you trade based on this one thing? That's not smart, so you have to kind of, be a little smart about it. Does this make sense? Look at those cases in which here's how I would apply the rule, and then always be open to new data, right? Because we're constantly getting more and more information, and make sure you're constantly testing your hypothesis. Does it hold up? Because, the best scientists, I think, are those that don't hold their convictions so firmly that they're unwilling to look at new data and change their minds. I think Stephen Hawking was a great example of someone who loved being proven wrong because he said, look, that means you've learned something. Thomas Edison, how many times did he, choose different elements for the filament on the incandescent light bulb before he came up with the right one? And he always looked at it as, hey, here's another thing that just doesn't work. I'm that much closer to the final solution.
Right. Yeah, that's fantastic, and I think really good advice. And I was wondering if you could talk about the output of a particular study. Do you kind of keep it all in Excel and just show like performance metrics, or do you kind of make a report with some nice visualizations, that type of thing, that kind of drive home the point of the conclusions of the study?
A lot of times it was a combination. You want to have some type of summary, some type of summary of ideally with some percentages. Like, for example, when we're looking at the follow-through day, one of the things we were talking about is the follow-through day undercut. Okay, if you close below the low of the follow-through day, how often does that lead to a failure of your rally and as an early warning signal? And of course, there's different ways to approach that. Is it a close below the low, or is it just a test of the low that causes that? And so you have to kind of look at both cases. So sometimes we're looking at the ultimate low, sometimes we're looking at a close below a certain area, moving averages, all of that. So it's a good idea to kind of get a overall summary, but then I always like to kind of show those extremes. Here are cases where it worked perfectly. Here are cases where it didn't, because I can't think of a single indicator that's 100%. So what did the cases look like that didn't work? And did those make sense? Oh, you know what? It made sense that it didn't work. Or, hey, sometimes, the best the best indicators, they have a certain failure rate. And sometimes you get that failure rate, right? You have to be prepared for that and manage your risk accordingly. So I always felt like there was a combination. And, sometimes that, I guess that presentation, especially because Bill, he was running all of these different companies and, managing a portfolio. So you had to kind of really think of how can I really make this into an easily digestible conclusion. And then if he needs more information, you better have all your backup, because he's going to ask you a lot of questions. If it's something that he's intrigued by, you better have all your backup so that when he asks you, hey, but what about this? What about this? What about this? You've kind of anticipated a little bit what flaws might be there. So you have to start poking holes in your own study. You have to think of what could other people say, and do you have an answer for it? Do you have an explanation, for a lot of those things?
Yeah, super interesting. And in terms of the actual logistics of creating a study and doing a study and performing a study, where did you kind of get your data? Obviously, you've got access to all of IBDs and Marketsmith, but people out there probably don't have that. So do you have any kind of suggestions for where to find data? I've used kind of Yahoo Finance, which is a free option in the past,
Yeah.
and like Python. But in terms of actual logistics, what would you do kind of nowadays in terms to get data and also to process that data and test all your hypotheses?
Mm-hmm. Yeah, I mean, and certainly one of the things you have to kind of do too is make sure your data's clean. I mean, even getting the data from William O'Neill and Company, which was a data provider, sometimes there were quirks to the data. There was a period of time, because I have some data going way back, and there were these periods of time where I'm like looking at the dates and I'm like, what's going on here? It's Saturday dates, and it's closed on Wednesdays. There's no data for Wednesdays. What's going on? And for a while there, they were closed. The market was closed on Wednesdays because there was so much paper that they were dealing with that they were, scrambling to just kind of catch up. So sometimes it was a little bit of a learning in history. Even what days the market's been closed in the past. Certainly we can, think of the outliers recently, like when Hurricane Sandy hit and 9/11 hit, where the index was, or the exchanges were closed for multiple days at a time. But there's these days where presidents have passed away, and things like that. So kind of just making sure your data's clean. Sometimes what I would do is I would just do some checks of, hey, are there any days here that are wildly unusual, just to make sure that there wasn't a bad data point. Because the last thing you want to do is you're running all these studies and, you've got some bad data in there. And after you do all this work, you find out after the fact. So it's hard to find a completely clean source. There's always going to be some bad prices and stuff. So just kind of making sure you've got clean data. I always like to do some checks to just make sure, hey, is there anything that's glaring here that just doesn't make sense? But once you have data that you can trust, then the sky's the limit on what you do with it.
Yeah, that's perfect advice. And getting a little bit now into your actual trading style, obviously you're classically trained can slim, but how do you kind of describe your overall trading style? Because I know you ran swing trader with Mike Webster, which is a little bit more faster than the classic position trader. So you yourself, when you trade, how would you kind of describe your style? What's kind of your holding period, average gain, average loss that you shoot for, and how have you kind of adapted can slim to match your own personality and time frame?
Well, one of the things I've certainly learned about myself over time is I hate to lose money. So that's not necessarily a good thing, because in order for you to have a lot of these big gains, these really life-changing, huge moves, you have to be able to sit through some pretty ugly downturns. I'm much more of the mindset of, hey, look, if I can sell some into strength, maybe sell the remainder on some weakness, and then always have that option of buying it back. That's usually my preference. And it's just a different environment to a certain degree. I mean, when I first started, my account was $2,000. It was Ford stock that I inherited from my great grandmother. After she passed away, she worked for Ford for a number of years, and so I had $2,000. Well, each time I made a trade, it was $30. $30 coming in, $30 coming out, and for $2,000, that's a hefty commission. And so as you get larger, of course, that commission becomes less and less important. Or in our case now, well, there's no commission. So that changes things a lot. But certainly early on, that was a big, consideration for me in terms of how much trading I was going to do. But now, again, having some size, not having to worry about commissions, it's one of those things where there's a lot more freedom to be more flexible. And that's what I saw Bill do. He had a lot of times where sometimes he was just buying 100 shares, which for him was nothing, but he'd just be buying 100 shares just because it was up, just because he wanted to have a little bit more money into a certain stock. And having that flexibility, realizing that it's not all or nothing. A lot of times, again, at the beginning, I felt like it was all or nothing. The commissions were so much that, I either was gonna stick with it, or I was gonna be out and I wasn't getting back in, for a while, because I'd already taken a hit on the commission. So I feel like it doesn't have to be all or nothing. You can sell some into strength. You can sell a little bit on weakness. You can always buy it back. There's just a lot of flexibility. So I try and remain flexible myself. I think I have gravitated a little bit more towards shorter term trading, and and I would say that's in the last 5 to 7 years. But this market has been, I think, a little bit more geared towards that. The exception was when I was really trying to do it a lot more was in 2017, and that was just not a great that was not a great time to be swing trading, at least the way I was doing it. 2017, I'll just admit, I was frustrated. I looked at 2017 and looked at what the indexes did and how easy it looked. And then I looked at my account and I'm like, what did I do? So again, I had been at this for a while, and I was trying something new, and it wasn't working because it was not the right environment for it. There was too much sector rotation there. And if you just kind of held your stuff through a lot of those corrections that were minuscule, like 3.4% was the biggest correction on the S&P 500 in 2017, just holding through a lot of those, and you would have been fine. But I was just out of phase, and that happens sometimes. You have to not necessarily beat yourself up because you had a bad year or you underperformed the indexes in a year. You have to, I think, pick yourself up, dust yourself off, and say, okay, what did I learn from this? And look at the overall. Okay, it's okay to be off one year as long as you learn from it, you get better, and as long as overall you're doing very well, right? And this is one thing I would just tell people that are just starting out. Don't think you're going to kill it every year necessarily. There are some people that do, absolutely, but a lot of times you're not going to be killing it on every stock, and you're not going to be killing it on every year. You're going to have those years that are your life changers, and it's a matter of, I think, staying in the game, making sure you're not getting knocked out so that you are there for those life-changing moments when everything does kind of fall into place for you and you treat it right and you handle it right, because one of those years can make up for tons of years that you're not doing as great. You just have to be there and learn enough to handle those 1 years right, or those one stocks, because in a lot of the studies that I've done, it's 8 to 10% of the stocks that become those outperformers in your portfolio, that cause the outperformance in your portfolio. It's about 8 to 10% of them, not your entire portfolio, that's necessarily working at the same time.
Yeah, absolutely. And coming back to kind of those statistics, your kind of average gain, average loss, batting average, do you have a sense of those statistics for your own trading?
I mean, I do kind of keep a sense of it with, kind of on a short-term basis. So I don't know that I have like necessarily a long-term, like over years, because again, sometimes I'm, doing different styles and I have different accounts. I would say that I'm not necessarily over a 50% win rate on my stocks. I have a lot of losses, but I cut them very short, and so they don't hurt. And every now and then you have a Tesla that can just it only counts as one, right? It only counts as one win, but that win wipes out so many losses. And there have been a number of times where even just playing some of the index ETFs, sometimes I'll be in TQQQ, which is the leveraged ETF on the Qs, it's triple leveraged. And sometimes that can be one of my better plays because I just got the market right. And, by playing that correctly, that can take care of a lot of the mistakes that you make along the way. And you just have to approach it as there will be mistakes along the way.
Yeah, absolutely. And going back to the batting average point, you don't need, there's this kind of this assumption, especially with new traders, that you need to be right 70, 80, 90%. Mm-hmm. Every one of the people who I've interviewed, their batting average is under 50% for the most part. On average, they're going to have years like 2020 where it can be higher than that. And Ryan Pierpont, who's an excellent trader, I think his batting average is in the 30s, but it's all about getting the most out of those, outlier gains that can pay for all those small losses, and you got to cut your losses short. So I think that's perfect.
No, that's exactly true. You have to keep your losses small. Otherwise, they overwhelm everything. And not only that, but it's not just the physical capital you have to worry about. It's the mental capital, because you start taking some big losses and you hesitate. It's almost like you're traumatized a little bit. So you're just a little bit more frightened on that next trade, or a little bit hesitant, and that's where you can get into trouble. So it's not just the physical capital you have to protect. And just to share a quick story from Bill, because there was a point in time where I was sharing my trades with him, and he was looking at what I was doing, and he was asking me questions, and he was saying, why weren't you taking your profits here? Why weren't you taking your profits here? And every time my answer to him was, I thought this was going to be one of the big monster stocks. And he's like, why do you think you're so good that every stock that you pick is going to be a monster stock? And he said, I expect one or two at most in a good market to be like a really big winner for me out of 10, one or two out of 10, and to be a really big winner. I expect 3 or 4 to have decent gains, above 5%, 10%. But then I expect the others to be small losses, 50% to be small losses. And that's Bill O'Neill. So once I kind of got that in my head, okay, let me change my expectations here. It was an important lesson for me.
Yeah, I think that's really important. And yeah, that's great. And Justin, I want to get into the current market conditions a little bit. So would you mind sharing your screen, and maybe we can pull up an index and kind of talk through the current environment? Because speaking of, protecting that mental capital, a lot of people are probably feeling a little bit demoralized here because we are in a correction in the kind of a bear market. So yeah, could you just kind of talk us through this chart, what you're watching here, and what you're looking for to maybe signal another new uptrend?
Well, and this is where it's interesting, because a lot of us have been talking about how the obvious top here was in November, right? November 22nd. It was right around the time that the Omicron news was coming out. That happened right around Thanksgiving, and it just seemed like the market really couldn't get its bearings. But you have to remember that a lot of what was happening during this entire move here in 2021, it was the big cap, what I call the $1 trillion club, that was driving the indexes higher. Your Apples, your Microsofts, your Googles, your Teslas. That's what was driving things higher during this 2021 period. And in reality, what was happening was a lot of the leaders of 2020 and they were topping in February of 2021. So if you kind of take a look at some of the indicators, and one of our favorite things to look at lately has been on GMIAB, ticker symbol for Marketsmith. This kind of brings up some of the indicators. So you have the Amex up here, you have the NASDAQ here, and you have this advanced decline line for the NASDAQ. But you can see way back here in February, that's kind of where the advanced decline line topped. And really what we were seeing a lot of times was there was a lot of devastation under the surface here in the market. And so that was really something that made 2021 very difficult. If you were in the $1 trillion club members, everything was fine. You were saying this is a great market. Or if you were in the indexes, you were, having a great year on the S&P 500. But if you weren't in, if you were trying to play, God forbid, some of the leaders of 2020, like Zoom, or Shopify or DocuSign or some of those, you were seeing some really devastating action. So again, you have to kind of always, it's not about where you're at right now. You have to kind of look at where you've been too. What's your position? So getting back to the S&P 500, recognizing that we kind of had this top happen in November. You come down, and the thing is, you had the distribution here, piling up. You started breaking the moving average lines, but you also had this mentality of buy on the dips. And so for a long time, just look at back here. So here we are, November of 2020. Okay. This is when vaccine day happened, right? November 9th. That was look, I got clobbered on November 9th. That was a bad day for me.
I think I had Tesla and Peloton on that day, which both gapped down on me, but
yeah,
definitely an interesting day.
That was a rough day. But what started is this, this huge move in the indexes, and it really trained people, and even before this, I mean, if we go to the weekly chart on the S&P 500, and you go back to even the COVID crash, you just had this you really obeyed that 10-week moving average line, very well, except for that little blip there. You just kind of came down to the 10-week moving average line, and then you bounced up. And so that kind of gets people in a mindset of all you have to do is just buy on the dip. And I mean, those were famous last words in 2000. I remember, so many analysts, coming up with the brilliant, strategy of, if you just buy Cisco and Yahoo on the dip, you'll make tons of money. And that strategy was working brilliantly until it didn't. And that's the problem, is you have to have that strategy for when it doesn't work. So that's the market that we got into here. And look, we never know how bad things are going to be. I've never been able to predict how long a correction is going to last, or how deep it's going to be. And there's no information that I know of that tells you, at the start of a correction, that information. The only thing I can say that will help you a little bit in that regard to know that something might be a little bit more serious is when the psychological parts get a little bit out of whack. So what I mean by that is, either you have gotten tremendously extended, you have been going on a run for a very long time. And when I talk about tremendously extended, let's just, for looking at the base case scenario of, what that looks like. This is the NASDAQ in 2000. This is what extended looks like when you're going straight up like that, when you've been going up, tremendously. And even the S&P 500 during that time, not as much, but this was a very prolonged move. So when you start getting way out of whack like the NASDAQ did, that's where you can expect things to come in harder. And a lot of times take longer. But, I'll be honest with you, when the COVID crash happened, I thought that thing was going to last a lot longer. I thought that was going to, because we did have this decent move, in 2017. We took a little bit of a break in 2018, kind of came up after that, that Fed-induced bear market there. But this, I just thought we were going to need more time, especially given the news that we were dealing with. And I guess this is the benefit of using charts, because if I had gone with my gut, if I'd gone with my emotions, man, I would have missed out on a huge opportunity here. This was it was my best year ever. And it would have been a shame if that hadn't happened. This was one of those life-changing years. And if I had gone with my gut, I would have missed it completely. So where we're at now, don't know how long it's going to last. Don't know how deep it's going to get. But I can tell you right now, the fact that we've gotten to these undercuts, and it's been a little bit rough, showing action, especially this week. You had a lot of strong opens, weak closes. This was the first time that we were kind of able to hold on to our gains. So that's promising, but it's only one day. And just one other thing, it's not just about the index itself, right. It's also about the quality of the merchandise that's out there. Let me just take a look real quick at the NASDAQ 100, and I'm gonna just real quickly go through some of the stocks that were up the most today from the NASDAQ 100. So let's go ahead and do this. Let's, for as strong as this day looked, and this is something I was doing at the follow-through day that we had on the S&P 500 on March 16th. That was right here, and it was a strong day for the NASDAQ. What was driving it? So if we just go through real quick, some of the biggest gainers on the NASDAQ 100, and we can start with Meta Platforms. This is not a stock I'm interested in. This is way below the 200-day. It looks ugly. No, thank you. That's the one that was up the most, 17.5%. Next was PayPal. No, thank you. I mean, that just looks so ugly. Qualcomm, a little bit better, but still very ugly. I'm not interested. Thank you. Autodesk. I mean, and this is you can keep on going down the list, and this is what the biggest performers today looked like. So that is a concern for me. If it's the bottom, fishing that's driving the market higher, a lot of times you can get a move out of that, and we saw that recently with the Nasdaq's move in March, but it didn't last, right? It was almost like, hey, we're gonna drive these things up, and then it came right back down. Contrast that with the Nasdaq. Let's just go 2 years ago to 2020. Here's the COVID crash right here, okay, in March. Let's look at some of the stocks that were setting up during that time. NVIDIA was one that came out in April. Like I think we put this on leaderboard April 14th. So coming out right here. Hey, that's something that looks like something, right? It's above its moving averages. It's got a relative strength line that's in new high ground. Microsoft, that looks interesting. It's something that is worth considering. Zoom at the time, hey, that looks interesting. Again, it was a completely different look to these charts than what we're seeing right now. And you know what? I actually made a mistake. I should have, instead of going to the 28th, I should have actually gone to the 6th, which was the actual, follow through day. So even this, the base hadn't finished here on the follow through day for Zoom, but you could at least see, hey, this was something that was coming down to the 50 day, not something that was completely destroyed. NVIDIA, that was back above its 50-day moving average line. A base was forming. Microsoft, and again, the relative strength was looking very strong on these on the follow-through day on the NASDAQ on April 6th, 2020. So merchandise, do you have merchandise to buy? That's a huge thing. In the current environment, or at least this year, it's been very cyclical driven. You've got the commodities, you've got your oil, gas, coal, the fertilizers. And, a lot of people say, well, gosh, this is just, can slim, can't play here. I saw Bill do it. And this was a surprise to me. I think it was in like 2005 where I saw Bill looking at, Valero. And I'm like, what are you doing? This isn't a can slim stock. You're breaking your rules. And he told me to just go back and look at the model books. Even if you look back in How to Make Money in Stocks, there's a number of cyclical stocks in there. You've got some oil stocks in there. You've got some energy, and metals and things like that. And heck, if you go way back in that chapter 1, you're going to see all sorts of commodities. At the early part. So again, it's you have to understand that these can have their day in the sun. The chart often is going to tell you this is what's leading. The relative strength lines. When I'm looking for leadership, I'm often looking at those relative strength lines because they're just such an important clue to tell you that this is what's leading the market. And as ugly as those charts looked, and I'm sorry if I'm going on a tirade here,
no, it's all good.
Soapbox. But as ugly as those charts looked, one of the things that reminded me of, and I'll go ahead and share my screen again here. But one of the things that reminded me of, is 2009. So if we go back to 2009 and, the S&P 500, let's just look at how devastating it was on the S&P 500. So you had the financial crisis where, we had topped in really in October of 2007. That's where a lot of the individual stocks topped. You had this little rally in March. And I mean, there were some stocks that were working there. CLR, I remember, was one that, some of the portfolio managers were playing at that time. But then you had this real major devastation. Lehman Brothers, Bear Stearns, the whole mess. Will our financial system even survive? Those questions. But after all of this was said and done, while the S&P 500 was making these new lows in March, you had some stocks like Apple that, look, this was going sideways for 5 months, But when the S&P 500 was making these new lows, Apple wasn't. And what was happening to the relative strength line? Popping up. This is something that Bill was buying right around 92, if I remember correctly, on a shakeout +3. You also had a Priceline booking, of course, is the ticker symbol now. Look at how this looks compared to the S&P 500.
Right.
It was back above its 200-day line. One of the few things that was in April, and again, the follow-through day was right in here in March. So it was still below that. But this was one of the few times that I saw Bill buying stocks below their 200-day lines. And what do they all have in common? Their relative strength lines were soaring. So right now, that's where I'm looking. I'm still looking for those relative strength lines being strong. And right now, it's a lot of the bottom fishing that is driving this market forward. That was happening in 2009 too. I'll be honest, 2009 wasn't a great year for me either, because I wasn't doing all that bottom fishing. I would have been much better off if I had just bought the indexes and stuck with that. I eventually started participating, but I was late, and while I was watching Bill do that, it took me a while to catch on to what he was doing, and it wasn't for a while that I'm like, wait, he's really getting heavily invested. And then it was kind of like, oh, I'm late to the party now. So I better learn this for next time.
Yeah, perfect. And outside of just stocks that are showing that relative strength, the relative strength is in an uptrend. Do you look for overall groups that are also all participating together and try to narrow it down to those leadership groups that can make giant moves? Like back in 2020, we saw the software names really take off. All those did incredibly well. So yeah, is that something you do as well?
Absolutely. So, on IBD Live, one of the things that I'm tasked with every Monday is to do a quick little overview of the industry groups. So every weekend, as part of my routine, I, go through and, just take a look. I of course do it in Excel because, why not? I love Excel. So I'll just put together an Excel spreadsheet and kind of look at, okay, what were the biggest movers of that week? What were the biggest, a lot of times I look at the outliers, the extremes, what moved up the most, what moved down the most, what kind of changed rankings. And I also take a look at like the Growth 250. The Growth 250 is a great list of here are the stocks that are acting well. And the way that was created, Mike Webster really, spent a lot of time on it. He worked with Bill on a number of screens. And look, both Bill and Mike had one thing in common. They didn't want to miss anything. So Mike came up with 30 screens, 33, I think, to be exact, working with Bill to say, okay, if it doesn't have this, it's got to have this. If it doesn't have this, it's got to have this, and so all of these different things, put it all together, and that became the basis for the Growth 250. And so I often look at what changes are happening in the Growth 250. Where are those stocks moving? It's been interesting because a lot of movement has happened in the REITs. You've seen more REITs than I've seen in a long time pop up in the Growth 250. And that just tells you something. That tells you about a little bit of where the money is flowing, where the strength is. But certainly, it was one of those things that very early on you could see oil and gas, being one of the top groups for a while. It was getting more and more names going there, and more names coming out of the technology sector. And so you could see that rotation happen. But definitely something I watch. And a lot of times you can see that on the charts. One of the things I'll do is, I'll just go to, and let me share the screen again real quick. Mm-hmm. One of the things I like to go to is if you go to some of the different reports, scroll down to the beginning, you have the industry groups here. You can see a daily percentage change. So this can give you a sense of, hey, what's moving today? So, I can sort that and say, okay, computer software design was one of the top groups today. The drillers were a top group. Transportation truck, which has been getting devastated, that was a top group today. Semiconductor fabless, computer software, specialty enterprise. So again, you just kind of start looking here to see what moved on a given day, or you can sort this by the 3 month, or whatever you want. There's a lot of different ways that you can slice and dice the information so that you can kind of get the information of what's moving. But at the end of the day, a lot of times I'll just sort this industry group rank by the number one group and just hit the space bar and go through these charts and see, hey, what looks like it's holding up, what looks like it's potentially coming down to a level of support, like a lot of the oil and gas was, and what looks like it's just completely clobbered. And that gives you a good sense of where the groups are. You also have to, just like with studies, you kind of have to understand when there's little nuances. This is a price-weighted index, these industry groups. So you have to be aware that sometimes you can have a single stock overwhelm a group. Tesla for a long time. Oh gosh, I look at the auto manufacturers and it looks very similar to the Tesla chart. Well, Tesla's a high price stock. It has an overweighted influence in the auto manufacturers. You look at Ford and General Motors, they look very different than Tesla right now. So, you have to understand that there's often limitations for however you're looking at stuff. If you're using market weighted, there's limitations to that because you get the $1 trillion club having more influence than a lot of these other stocks. If you look at equal weighted, well, there's limitations to that because how many of us, are going to be selling our selling our winners to put money into our losers? That's what an equal weighted portfolio does. So does that jibe with the way that you trade? So you just have to kind of understand whenever you're looking at data, what are the limitations of it? What is it showing you? And what could it possibly be hiding sometimes?
Absolutely. And pivoting a little bit, Justin, I wanted to ask you, just because it seems pretty relevant right now. Have you done any studies looking into the Fed and monetary policy and their actions and how that impacts the overall market? I wondered if you've done anything like that.
Yeah, you know what? We used to produce these wall charts that were just amazing pieces of information because they had all of this data, like the presidential elections and who were the Democrats, Republicans, what the Fed funds rate was doing, and all of these different different elements of the economy. So that is definitely something worth watching. In fact, it's funny you say that because the podcast that I just did that dropped today was with David Saito Chung, and he brought up 1994. And of course, in 1994, you started 1994 with the federal target rate, the Fed funds rate at 3%. And starting in February of 1994, you had multiple rate hikes, starting with a few 25 basis points, then 50 basis points, up to a 75 basis point hike. By the time they were done with that rate hike cycle in a year's time, they had gone up 300 basis points. So from 3 to 6, now that's a double, right? So what happened in 1994? Well, let's take a look. Mm-hmm. I'm just going to share my screen. So if we take a look at 1994 and we just pull up the NASDAQ composite, and I'm going to go to a weekly chart. So actually, let's go to 1996 so you can kind of see a little bit. Now, remember, this was a phenomenal, move in the 1990s that we had. And 1994, during this whole rate hike cycle, you had a lot of this, kind of basing action in the market. Mm-hmm. And it's not that if you look at the S&P 500, it was the same thing. So let me just get over here to the right area. You saw that basing action. So it wasn't just the NASDAQ. It didn't come down very much, and it hit the lows pretty quickly. And those lows, kind of were held. But man, you didn't make much progress. And a lot of the stocks that were the big winners, they were taking breaks during that time, including Cisco. So that's something that people can definitely get more information on in the podcast that we just dropped at investors.com.
Yeah, fantastic. But coming out of that, there was an amazing uptrend.
Oh, so absolutely.
We got to be ready for that.
Absolutely. Yeah. So I again, this is why, some people, will kind of, well, we almost hate to tell them this, don't cancel your subscription because you never know how long this is going to last, and how are you going to know when to get back in? If you look at a lot of sources, they're either going to get too excited on days that don't mean anything. It's like one day, some of the best days that you'll have in the market are in the worst environments. We saw that in just recently with the COVID, crash. You had a day that was up like 10% on the NASDAQ, followed by a day that was down 12%. Right. So you can't get too excited about a single day. But at the same time, once you do see that trend change, it usually takes a while before people really believe it. And if you're late to the party, by the time you feel safe, well, you've missed out on some of the best opportunities, because there's this window of buying where the best merchandise comes out. And that's where you want to make sure that you're right there and observing it as it happens. That's why it's important to have your watch lists fresh, and be aware of what industry groups are moving, be aware of what relative strength lines are looking strong, and everything else that we do as just part of our regular routine.
Yeah, absolutely. And Justin, since you've done so much work on researching them, I wondered if you can kind of give an overview of what a follow through day is and what it might look like, just not just in terms of what the indexes are doing, but also, as we talked about, we also want to take a look at what individual stocks might be doing, whether there's industry groups as a whole shaping up and showing that that increasing relative strength line during that. But for people might be completely unaware of what the fall through day is. So if you could also give just an overall definition, that'd be fantastic.
Yeah, so let's go ahead and we'll use that 2020, because again, this is where I just have to thank my lucky stars that I have the follow through day concept ingrained in my head, and not using my emotions and my gut. And so here we have the COVID crash. And so first of all, you start with a downtrend, and then you need to know, okay, what tells me that I've got a signal to potentially get back in. So what you look for is a day up. And here's that day that I was talking about where, we had a strong day up here. The S&P 500 was up 9.29% on the 13th of March. One day is not enough, okay? Because the very next day, there we are down 12%. So one day is not enough. I like to think of it as you need a confirmation of the strength. If you remember back to geometry days, right? How do you have a line? Well, you need 2 points, right? You can't just have 1 point for a line. You need 2 points. One, and then an uptrend tells you that you've got another point that is hopefully higher. And that tells you that your trend has potentially changed. So you look for a rally day. So that's a rally day, but then we immediately fail. So you stop counting. But you're just going to start counting day one of the rally. So here's day one, day two, day three, and then you look for a day of power. Once you get to day 4 or later, you're looking for a day of power that confirms the strength of your rally. It has to be up, generally we're looking at a 1% or more, depending on how volatile your market is. It's got to look powerful, right? In some markets, 1% is like, well, that's just the average, the average move. That's why in 99 and 2000, Bill upped the criteria. He said, you know what, in this market, we need like 1.7 or maybe even 2.1 for a follow through day to mean anything, because the average day is up, or down well over 1%. So it has to look like a day of power. And so as you keep on counting, so here we are on the S&P 500, day 1, 2, 3, 4, 5. Now this day was strong. It was up 3%. But here's another component that we need. We want the volume to be heavier than the day before. It doesn't have to be above average, but it has to be heavier than the day before. So we didn't get it there. We had the price, but not the volume. So we keep on counting. Okay, so where was I at? 1, 2, 3, 4, 5, 6, 7, 8. Here's another day that's up enough. But, the volume is there. That's your follow-through day. April 2nd on the S&P 500. So even though this was, had come down, you were still getting some power there. And now on the NASDAQ, it's often nice when you have multiple indexes follow through together. but a
Hmm.
lot of times one will be a little bit quicker than the other. And so here we are on the NASDAQ. Here's that April 2nd day. The volume was a little bit lower. So it didn't qualify as a follow through day, but you just go a couple more days out, the 3rd, and then, here we are at the 6th, and that was your follow through day on the NASDAQ. So again, if we just kind of look at some of the stocks that were, setting up at that time, like we did, you've got your NVIDIAs and your, your Microsofts and so on that looked like they were, potential. Oh, I switched this to 2022, unfortunately.
Yeah, no worries.
Okay, so yeah, if you look at your NVIDIAs and your Microsofts, those were setting up. Those had relative strength lines at new highs, and even though this was a very steep correction, usually we're avoiding corrections that are 40% in a stock, but given what happened in the index, sometimes you have to make allowances. One of the situations that was early on in working for Bill, I watched what he did with Charles Schwab, and here's Charles Schwab. It's very compressed because this is an arithmetic chart, and Charles Schwab went up so much. It was up over 400% in 6 months, ended with this climax run. But if we go back to October of 1998, so this was right after you had the long-term capital management. They blew up, right? The Fed had to bail them out. So you had that going on in September. And I'm just going to start with the S&P 500. So you had this S&P 500 come down here. You had a follow-through day in here. And by the way, this was a lesson for me. I played this follow-through day. It didn't work. It rolled over. And then when this follow-through day happened right here, I didn't play it because I said, oh, you fooled me that time. I'm not going to fall for that again. I didn't play that one. But look at what Charles Schwab looked like on that day. Right there, breaking out of this cup with handle. And I was asking Bill, like, gosh, that handle seems overly steep. This base seems overly dramatic. It's a 40% depth. The handle is 27%. It almost looks like a double bottom that just didn't undercut that second leg. And he said, well, go back to the market. Look at what the market did. You have to put it in the context of what the market did. And what he thought was strong about Charles Schwab was when the S&P 500 undercut here, Charles Schwab didn't. And so here we are. We're back to that same concept of what we saw in 2009. The stocks that didn't undercut were the stronger ones. They had the stronger relative strength lines, and that's where you're going to find your leaders.
Yeah, perfect. And going back to the fall through day concept, what's kind of some probabilities with the fall through day, and also when would a fall through day fail? As you just mentioned back in the 90s, what does it have to undercut to qualify as a failure, where you need a whole nother rally to potentially restart an uptrend?
Well, ultimately, when Bill would say, look, this rally is a failure, is when it undercuts the low of your rally day. That's it. But that doesn't mean that you're not getting out before that, right?
Mm-hmm.
And here again, I have to stress that I don't, I learned early on not to plunge, because I did that, I did that early in my career and got my head handed to me. A follow through day doesn't mean you go in 100% or on margin. It means you start to test out the waters. So when that rally day is undercut, that's the rally is done. You can have some cases where the follow through day is undercut and they still work. Those are rare. Most of the time, you're gonna undercut your rally day low, and it's gonna be difficult to make money. But then beyond that, in terms of success rates, this is where it gets a little tricky, because a lot of times when you're doing a study, you have to be very careful to define your terms. So I would ask, what does it mean to be successful? Is it, and the way Bill would define it is he would say, well, could I make money? Was it long enough and going up enough that I could make money in this market? And sometimes that can be very short, but if the signals are clear and you don't get the rug pulled out from under you, you can still make a little bit of money. And so he would consider that, hey, I made money. That was a successful rally. So we actually just did a very detailed analysis of this. We had Eric Kroll on, and Eric
Yeah.
Kroll is one of the co-authors of the Life Cycle Trade. He's done a lot of studies himself, and on the podcast, he went through his data, which pretty much matches a lot of what I've seen myself in terms of the signals that kind of tell you when a rally is going to fail. Especially that follow through day undercut, seeing distribution, a lot of distribution. But a lot of times it's going to come down to your individual stocks. That's not necessarily going to show up in the indexes immediately, but you're going to see it in your portfolio. Your choices, your decisions, they're not working. The market's giving you feedback saying, hey, there's something wrong here. Either you're off, you're in the wrong stuff, or this market just isn't working. And so as long as you're paying attention to those signals and that market feedback, you can usually get out without getting too damaged. And that's what it's all about, is making sure you're not taking big hits.
Yeah, absolutely. And Justin, since you were so involved in market school, I want to ask you to talk through kind of one last concept here. Could you
Sure.
talk about a power trend, which obviously we're not in right now, but what kind of constitutes a power trend, and how should you kind of change how you're approaching the market and trading when we've got that strong a trend?
Sure. So a power trend, and this was an idea really that Mike Webster, wanted to come up with, to kind of say, look, when you have certain markets, you want to treat it a little differently. You want to hold a little bit more. You don't want to go all to cash necessarily, because if you've got a lot of kind of cushion and profit behind you, you can give your stocks more room. And so he wanted to have something built into the model that kind of allowed for that. And Mike Webster did a lot of work on the 21-day moving average line. It was real interesting. After he had done all this work and he showed it to Bill, and Bill's like, hey, yeah, that looks interesting. I like what you've done here. I think that your studies are showing the usefulness of this 21-day exponential line. And there was one point in which Mike and I were looking at some old stuff that Bill had done. We sometimes uncovered just these huge gems, like some of the original follow-through day study work that Bill did, where he was just painstakingly, not using a computer, he was just painstakingly going through charts and making observations, again, studying the fish. And he found something actually from Bill showing a 21-day moving average line and saying, hey, this is something that looks like it worked. And it was from decades prior. And Bill had even forgotten about it. He's like, oh yeah, that's right. I remember I did something on that. But the 21-day moving average line is one of the essential components of it. So is that 21-day moving average line above the 50-day moving average line? So that's a big part of it. And it's got to be above there for a few days, because we found that if you just had one day, well, gosh, it could come down the next day. So you want to be trending above it for a little bit, and you want your price to be above the 21-day moving average line. So we kind of put some days in there, 5 days for the 21 above the 50-day, 10 days of your index above the 21-day as a starting point. And then Charles had another component in there, having the 50-day moving average line in an uptrend, because it's very different when you're coming off the bottom very strongly. You can very quickly get what could look like a power trend, but you're still early in the move. If you've got that 50-day moving average line in an uptrend, that's helpful to say, hey, this is something that's a little bit more sustained. Now, once you get those elements, that just tells you, hey, you might want to, if you are getting good profits and good cushion in your stocks, you want to be a little bit slower in doing your selling, or getting completely to cash, or raising too much cash too quickly. But if you don't get the cushion, well, guess what? You're gonna probably end up getting knocked out of your stocks anyway. No harm, no foul. So it's not an excuse to ignore sell signals, but the power trend just says, hey, this might be one of those cases where you want to try and hold on to those stocks that you have cushion on a little bit more. And so that's the general concept. And again, when we tested it out, it really seemed to do well for the model, and helped us kind of just not get whipsawed out of good markets.
Yeah, perfect. Justin, I know we're running short on time, so I want to thank you so much for walking us through all those concepts. I particularly enjoyed talking about studies. Maybe some people did as well. Maybe some people weren't.
Maybe some people, their eyes glazed over and they fell asleep. So hopefully.
Yeah, like the original market school seminars. I'm sure you remember that. Yeah. But Justin, thank you so much for coming on. I really enjoyed it, and I'm sure a bunch of people did as well. What kind of final advice do you have for traders out there who are beginners or struggling here? And what kind of general advice do you have for them?
I think one of the biggest things is be patient. A lot of people are in such a rush to make their fortune, get rich quick. That certainly was something that I was doing at the beginning. I showed Bill a spreadsheet. I used Excel in a bad way. I extrapolated what my gains would be after 10 years, assuming that the 90s was normal. So, he looked at it and he just said, "Oh, that's so cute. You think it's always like this." So you have to be patient. You have to realize that some of this stuff takes time. There were all those books that I talked about. Unfortunately, you can read all of that, but it's a whole nother thing to know those concepts. It's a whole different thing to implement those concepts and fight your emotions when you're in the heat of the battle. So that's a big thing, and really try to avoid the noise. There's a lot of noise out there, so it's very difficult sometimes to be overwhelmed, even using too many indicators. That's why Bill a lot of times just wanted to narrow it down to price and volume, rather than using stochastics and oscillators and MACDs and, all of these different things. Just again, study the fish. What is the price and volume doing of your stocks, of your indexes? Because that's going to tell you about supply and demand. And last but not least, don't forget about your mindset. You have to, protect your mental capital. You have to be positive. You have to be optimistic, and you have to be, I feel like, curious and humble and willing to learn more, and not think that you've just got it all figured out. Because this is something that's constantly changing. The certain concepts I think are timeless because human psychology doesn't change. I mean, that's one thing I learned from anthropology that I was able to pull into this field. But you have to be humble enough to always be learning, and that mindset is very important. And be open to when new data comes in, saying, "Hey, maybe my thesis is wrong." Being able to admit it and just move on. So many people can't admit that they're wrong, and so they plant their flag and say, "No, the market is wrong, and eventually it'll agree with me." Don't do that, because at the end of the day, you get a report card, and you either lost money or you made money. And if you lost money, you were wrong. It doesn't mean that you can't be right eventually, but how much pain can you take in the meantime? So those are just some parting words of advice, but it's certainly well worth it to put the time in, because you can have life-changing results. I've seen that over and over. So many letters would come into Bill that were just absolutely remarkable of what people were able to do because of these concepts that they learned, that they applied, and they were able to do, just amazing things that they never thought were possible in their lives.
Fantastic. Justin, thanks again for coming on. Where can people reach out to you if they want to learn more about your style or CanSlim in general? What are some good links to send people to?
Well, absolutely, investors.com. I mean, that's where the style is. I have a column that I publish weekly on swing trading, and usually that's taking examples from our swing trader product. You can certainly check out the podcast, Investing with IBD. That's drops every Thursday. And then there's IBD Live, where we're kind of hashing this stuff out daily in the morning, 10 minutes before the opening bell, and we go a full hour or more. A full hour and a half a lot of times into the market. So there's a lot of places you can get education, but you have to be careful not to get too much too quick, and always check your sources.
Yep, absolutely. Justin, thanks again for coming on. I really enjoyed this, and I'm sure a lot of people watching did as well. If you did enjoy it, please go ahead and leave a like down below and subscribe if you're new to the channel, and we'll see you guys in future videos. Thanks.